And what you're describing is this fixation that people have on whether 10-year rates should be 4.6% or 3.7% when we've basically been 4.25% for the last 3 years.
What is going on with the bifurcation in the market right now?
Yeah, this is, I'm going to just say it out. I posted something on X about academic macro being dead. And what you're describing is this fixation that people have on whether 10-year rates should be 4.6% or 3.7% when we've basically been 4.25% for the last 3 years. And you have what happened with Oracle this week. So the other companies you mentioned, like for Open and for Figure, I think there's a different situation when you're dealing with a company that is one of the largest in the world, who in a quarter said what they said, and then to have a stock of that size go up 40% in a day, and for people to still be arguing about whether the Fed should actually be cutting rates because the CPI, and I mean, we're literally talking about a scenario where whether the headline CPI is 2.9% or 3.1% or even 3.2, it's not important. It's not important to the people at home going shopping. 11%, 9% when food prices have gone up and people can't get them and toilet papers aren't on the shelves. I get it. It leaves people in a really big mental problem. But whether inflation is 3.1 or 2.9 is nowhere near as important what's happening with AI. And I think this week was the week of Oracle. And I think, and I'm sure we'll get more into it, but for me, this was the dividing line where I think this week between Oracle happening and the CPI being out of the way now, so the Fed's going to cut rates, I think all of the bearish sentiment that's been sitting out there where people refuse to stop with the tariffs, because that's what the CPI is. I'm worried that tariffs are still going to show up somewhere. I think this was the official ending of tariffs this week.
Oh, Madison, when I talked with him, talked about this idea of higher rates being actually stimulus. Mm-hmm. Bessett now I started to talk about some inequality stuff. Help us sift through this. Like, what's happening here?
Yeah, I mean, this is something that people just haven't understood, particularly on the macro side. And I think it was a confusing situation because when rates went higher, everyone assumed, okay, well, this will be a big problem. The issue is the government has a massive deficit. So they're printing money to give to the private sector in interest payments. So who benefits from that? People that have lots of cash. So especially the hyperscalers, they're loaded with cash. They have cash sitting in a bank. So they were actually making a lot of money. And that's why the net corporate interest payments actually declined when they moved rates higher. And that was a chart that not enough people looked at and saw. It collapsed all the way back to the early 1980s, which means that the companies that have debt, small cap businesses, most of them had termed out their borrowing, at least the companies that could, particularly the bigger companies, out a long time during COVID, when the Fed basically moved rates to lower levels, they all termed it out as far as they could. So they didn't have to deal with their issue. And then the bigger companies got the money. Same thing goes for the baby boomers. The people that suffer are the people that need to buy homes, people that need to buy autos, because those interest rates create an issue. And so mortgages, housing affordability is directly impacted by where rates are. So I think the reality is that what Mel said is something that gradually over the last few years has become something that more and more people realize, that when you have a big deficit and you have interest payments that's beginning, the government's losing, but someone's winning. And the people that are winning are the wealthy people that already have cash. And again, I think this is why Bessent put out a tweet to focus on the Fed needs to lower rates. And the reason they need to lower rates is to help the people that actually need access to the borrowing to be able to, I mean, young people they have time. They're going to have a job. They're going to have income for a while. They're not retiring for a long time. They want to build a family. You need to be able to buy a house, move into a bigger space. You need to borrow money.
Yeah, it's very interesting to me how no one, until he said it, I hadn't thought about it in that way, where like the government is paying interest to someone, which is the same thing as if they're sending checks to stimulus checks, right? Or the Trump bucks or whatever they were calling them. They're just giving it to you in a more acceptable form. And companies, wealthy people, they're the ones who are receiving that money.
Yeah. So it's a distribution which is not fair because it's based on how much money you've already received. And so by keeping rates at higher levels, there is a form of that going. That's why over time, if you go back and look at money supply growth, there is a relationship between what the interest rates are. So in the 1970s, when people were like, well, money supply was going through the roof. If you have money in a bank and the rates are 13% and you have any kind of income and you don't touch it because you're bearish and you just don't want to spend any money, your money grows to some degree. Now, if inflation is also 13%, then you're spending more out of that. And that's where this whole relationship comes between the money supply and also the wages. At this point, with where we have rates, money supply is growing fairly rapidly around the globe right now. Part of that is the government handing out this money through, again, having interest rates and having a deficit.
All right. So you say it's the official ending of tariff, like fear mongering. I saw a lot of people saying, oh, inflation is now 2.9% year over year. The tariffs are here. They're infiltrating into the inflation numbers. And they would go and they would find some data point. They'd be like, I told you the tariffs are inflationary. Look at this thing here. And by the way, these aren't like trolls on the internet. These are like well-respected economists and actually people that like we talk to on a weekly or every other week basis. I'm shocked at how many people are like, hey, inflation is here. Inflation is being driven by the tariffs, and we should all be concerned.
So here's the beauty of those economists. Their job, if they're at Goldman Sachs, Morgan Stanley, is to try and help investors make money. None of that is going to help investors make money. If anything, it's helping them lose money or underachieving. It is the reason why I spend all of the time that I do on AI. It's the reason that you and I basically got together because I believe AI is the gateway to crypto. Economists don't know anything about AI or crypto. Nothing. So what happened in Oracle, I mean, just to put this in economist terms, which no one put out this week, Oracle had an increase in orders of $317 billion. Okay.
Is that a lot?
That's a lot. To put it into context of economist terms, nominal GDP in the US is, let's say, 4.5%. At 4.5% on a $30 trillion economy, you're talking about, let's say, $325 billion a quarter increase. So Oracle in 3 months, their back orders grew by $300 billion. So what's more important right now than what's happening with artificial intelligence? And that's just the infrastructure side. That doesn't include the profit margin side. It doesn't include the adoption side. It doesn't include any of the other things that are going on. This is literally one of the largest companies in the world saying, we don't have enough capacity for the orders that are hitting us. Economists don't talk about that. They're still fixated on whether core goods services moved up. And I'm not kidding you. It gets rounded to where the big, let's say scary part today was, well, it came out at 0.346. If it had come in at 0.351, we would have rounded it up to 0.4. That's the stupidity that gets in for people thinking that is going to help you make money or not.